All right, let's get straight into it. Welcome to today's Explainer, where we're going to break down one of the absolute most frustrating things you can experience in the markets. I'm talking about that classic scenario we've literally all faced, getting stopped out right before a massive textbook market reversal. You know exactly the feeling, right? You map out a phenomenal setup, you get in, and you place a totally logical stop loss. And then, boom, you get tagged out by a fraction of a pip. And then, almost as if the market is just mocking you, it immediately reverses and sprints straight to your take profit target. It feels like the market gods are specifically hunting you. But, well, here's the thing. It isn't bad luck, and it is absolutely not random. Here is the brutal, behind-the-scenes truth. You actually weren't wrong about the market direction. You were just used as exit liquidity. Retail traders like us were often just the unsuspecting fuel for massive institutional orders. Those moves that snipe your stops, they aren't accidents. They are carefully engineered. So to really grasp why this happens, we have to look at what liquidity actually means in the smart money concepts framework. Basically, liquidity represents specific zones on a chart where there's a huge concentration of resting buy or sell orders. And yeah, mostly, those are stop losses. You have to remember the market is a zero-sum game. When the big players, the banks, the hedge funds, when they need to execute a monstrous order, they can't just smash the buy button without causing crazy slippage. They desperately need a massive counterparty. To put it bluntly, they need your stop losses to fill their positions. There's this quote in the trading world that honestly hits the nail on the head. Smart money doesn't chase, it sets traps. Think about that. Institutional algorithms don't just sit around crossing their fingers hoping for liquidity to appear. They actively, intentionally engineer price moves right into those clustered stop losses. Moving into Section 1, mapping the zones. This really exposes the whole duality of the market. First up, we've got buy-side liquidity, or BSL. This sits right above swing highs. It's basically a giant pool of buy stops from breakout traders, plus the stop losses of short sellers. When institutions want to short the market, they'll actually push the price up into this BSL zone just to trigger those buy orders. Why? Because it gives them the exact liquidity they need to sell into. On the flip side, we have sell-side liquidity, or SSL. This sits below swing lows, packed with sell stops and long stop losses. Institutions push the price down, trigger those sells, and use them to buy. While retail puts stops there for protection, institutions are literally hunting them for absorption. The crazy thing is, this liquidity isn't just randomly scattered. It clusters at highly predictable technical landmarks. First, you have previous day or previous week highs and lows. These are major structural boundaries, making them primary targets for massive liquidity sweeps. Next, we have swing highs and lows. These are the absolute extremes of recent price swings, super typical zones for your short-term intraday stop hunts. And finally, psychological round numbers. Think 1.3 thousand in Forex or say an even $100 in a stock. These are just glaringly obvious areas where retail orders automatically pile up, which makes them incredibly easy targets for algorithms. All right, Section 2, the ultimate magnets, equal highs and equal lows. Let's talk about the absolute gold mines for these algorithms. Equal highs, or EQH, and equal lows, EQL. These are your classic double or triple tops and bottoms that hit the exact same price level. Now, traditional retail technical analysis drills into our heads that these are, ironclad walls of support or resistance. So what do traders do? They tuck their stops right tight behind them. But institutions see this completely differently. What retail views as an unbreakable fortress, the algorithms look at as an all-you-can-eat buffet. It's just a giant magnetic pool of liquidity begging to be swept. Which brings us to Section 3, Anatomy of a Stop Hunt. Let's literally break down how one of these liquidity grabs actually plays out. It almost always follows a three-step sequence. Step 1 is mapping the pools. The institutions are using advanced algos to locate those dense zones of BSL, SSL, or those juicy equal highs and lows. Step 2 is the manipulative spike. The price gets shoved aggressively past the key level. Now, to the retail eye, this looks like a massive, genuine breakout, right? It tricks new people into jumping in while simultaneously tagging the stops of everyone already in. And then, Step 3, the reversal. Once all that retail liquidity is completely absorbed by the big players, the fake momentum just instantly dies. The price collapses right back into the previous range, and retail traders are left totally trapped. So how do we actually spot this happening on a live chart? You want to look for specific visual footprints. Keep an eye out for sharp 1 or 2 candle wick rejections right at those key levels. Think of a long dragonfly or a gravestone doji. You're also going to frequently see volume spikes with absolutely zero follow-through in the direction of the breakout. The price will quickly snap back and close inside the prior range, and you'll usually see a market structure shift in the opposite direction shortly after. Those sharp wicks, they are your best friends. They prove that a level was rejected, not accepted. And this actually brings up a super vital distinction, knowing the difference between a liquidity grab and a genuine break of structure, or BOS. A liquidity grab is essentially a failed break. Price spikes beyond a level, triggers the stops, and immediately snaps back. A break of structure, though, is a confirmed move where the price breaks a level and actually sustains itself in that new direction. The absolute easiest way to tell a fake out from a real breakout is just one thing: follow through. If it breaks out, rejects, and immediately reverses, well, you just witnessed a liquidity grab.
Moving on to Section 4, How to Avoid the Trap.
Now that we know how the game is actually played, here's your game plan for stopping being the fuel. Step 1. Establish a clear directional bias using your higher time frames. Step 2. Identify and patiently wait for price to sweep those key liquidity zones, like your EQHs and EQLs. Step 3, and honestly, this is the hardest one for most people, do not buy the breakout. You have to let the stop hunt fully complete itself. And finally, Step 4. Enter your trade only after you see a strong rejection wick and a structural shift back in the direction of your overall bias. Honestly, waiting for that trap to spring before you do anything is your single biggest advantage.
And a quick word on protecting your own trades. If you are dropping your stops right where every other retail trader does, you're literally painting a target on your own back. You've got to place your stops wider than those super obvious liquidity zones. Or better yet, actually, scratch that, the absolute best way is to use structure-based stops. Tuck them safely behind a deeper structural swing, instead of just resting them right on an obvious psychological round number.
So to wrap up this explainer, I want to leave you with a question that should hopefully completely change your approach to the charts. Now that you know exactly where the smart money sets their traps, are you going to keep being their exit liquidity, or are you going to start using their algorithms to your advantage? Start looking for those sweeps, wait for the trap to spring, and trade alongside the institutions, not against them. All right, that wraps up our deep dive into liquidity grabs. Thanks so much for tuning in, and I will see you on the next one.